Welcome to Daxue Talks, a show powered by Daxue Consulting, a China-based strategic market research company founded in 2010.
Hi, I'm Jess. I'm an audit manager from Dezan Shira Associates. We are a professional service firm providing all kinds of market entry, accounting, tax, legal, and other advisory services for international investors who would like to conduct business in Asia.
What are the 5 stages of the 5-step model framework for revenue recognition?
The new Chinese accounting standards, CAS 14, is very similar to the international accounting standards, IFRS 15 and ASC 606 from the US GAAP. So they all adopt this 5-step model framework for revenue recognition and measurement. So the 5 steps are: firstly, identify the contract, identify the performance obligation in the contract, determine the transaction price, allocate the transaction price to the performance obligations, and finally, recognize revenue when you satisfy the performance obligation. So I think these names are fairly straightforward. Basically, after you identify there is a contract, you need to identify the so-called performance obligation, where you need to assess what have you promised to deliver to the customer. So is it a batch of goods? Is it some services? Or is it about delivering the goods first and then provide service? In which case, you would have 2 separate performance obligations because they are 2 distinct products. And then you need to allocate the transaction price to these performance obligations based on their standalone selling price, and finally recognize revenue when you satisfy each performance obligation, which is when you transfer the control of the product to the customer. So you can easily imagine that this revenue standard will affect you the most if you have multiple distinct goods or services included in one contract, so that you will need to recognize revenue separately when you transfer each product to the customer.
We interrupt this show to bring you breaking news of more awesome China business tips. You can find these tips on our other China business channels. Follow our SlideShare for informative, free, hands-on reports on a variety of sectors. We publish 3 to 4 China business reports a month. Find the link in the description.
So what I would like to focus on today is about the transaction price, because the transaction price is a bit tricky and it's important because it would affect how much revenue you can recognize. So according to the revised CAS 14, the transaction price is the amount the company expects to be entitled in transferring the product, the promised products. So I've briefly mentioned this when I talked about the major changes in CAS 14. But anyway, so imagine that you signed a contract of 1 million Chinese yuan, but you only expect to receive 60% of it, for example. And this is because perhaps the customer is located in a country where there is a significant economic downturn, perhaps due to COVID-19 situation. But you sign the contract anyway because perhaps you think the customer is a strategic client, or because you think the country will recover very soon. So anyway, if you sign a contract like this, under the old revenue standards, you would need to recognize revenue of 1 million Chinese yuan and recognize 40% of the consideration as a bad debt. However, this is not the case under the new accounting standards, where under the new accounting standards, you can only recognize 60% of the consideration as a revenue, which is 600,000 Chinese yuan. So you see, under the old accounting standards, you would potentially record a significant amount of revenue and a rather significant amount of bad debt. But under the new revenue accounting standards, this is not the case. Instead, we will say revenue is recognized on a net basis. And I think the same principle or rationale applies for some special arrangements. For example, if your contract contains a clause that allow the customer to return the goods, then this clause would potentially reduce the amount of revenue you can recognize. In other words, we do not recognize revenue for products that's expected to be returned. So this is one aspect when you determine the transaction price. Another thing to consider is about variable consideration. So to understand the variable consideration, let's consider an example. For example, you agreed to, say, build a factory for a customer for 5 million Chinese yuan, and you both agree that the completion date should be, for example, June the 1st. And the customer tells you that if you complete the project before the completion date, they will reward you extra 10% of the consideration. However, if you complete the building late, which is after the completion date, you need to pay a penalty of 10% of the consideration. So the amount you expect to be entitled to in this case actually depends on whether you can complete the project on time. So you need to estimate the amount of a variable consideration based on its expected value in this case. So for example, if you estimate that there is, say, 50% probability that you would complete the project on time and 50% probability that you would complete it before the completion date. And then you need to calculate the expected value of the variable consideration, which is 10%, based on these probabilities. So this is one example about variable consideration. So consider another kind of variable consideration. Imagine that your customer tells you that if you win an award from the city council, say award of excellent quality of the building, then the customer will reward you extra 10% of the consideration. So in this case, the amount you expected to receive would actually depend on whether you can win the award of excellent quality. So you need to estimate the amount of variable consideration, in this case, based on the most likely amount. So you need to ask yourself, is it highly likely that you will win the award of excellent quality? And if yes, you may include the 10% extra consideration into your transaction price when you allocate the transaction price to the performance obligations. So the standard requires us to determine the transaction price at day one or at the inception of the contract and reassess it at each balance sheet date. I think it's pretty clear that there will be a lot of judgment and estimations involved when determining the transaction price, because you would have to really understand your business, your products, you have to understand your customers. And I think very often these judgments involves not only the finance department, but also the operation team, say the project team or even the legal team. But I think it's imperative that you do make such judgments and estimations, because it will affect how much transaction price you could allocate among different performance obligations, and it will affect how much revenue you should recognize.
Any questions? We will find an expert to answer them. Drop your questions in the comments or send us an email, dx@daxueconsulting.com.